All right, welcome to The Explainer. Today we're digging into a really fascinating story of corporate strategy. The company is Xpro India. And, this is one of those classic cases where you've got to look way past the headlines to really understand what's going on. So let's just jump right in with a big question. A real head scratcher. Why on earth would top-tier investors be pouring money into a company when, on the surface, its profits and cash flow look like they're falling off a cliff? I mean, it just doesn't seem to add up, right? So what's the real story? Well, here's the answer. And it's all about perspective. This isn't a company in trouble, not at all. It's a story of, well, calculated sacrifice. Xpro is intentionally taking a financial hit in the short term. They're letting their margins dip, they're burning through cash, and they're doing it all for one reason: to fund a huge, massive gamble on their future. Okay, so to really get this strategy, you need to understand that Xpro, well, it's kind of like a company with two different faces. It's not just one business. It's actually two totally different operations under the same roof, and each one has a really specific job to do. So on one hand, you've got the COEX division. This is the old guard, the reliable anchor. Think of it as their cash cow. They're the top dog in India for refrigerator parts, supplying all the big names like LG and Whirlpool. It just churns out steady, predictable money. But then, on the other side, you've got the Biax division. And this is the high-tech growth engine. This is the exciting part. They make these super specialized dielectric films that are absolutely critical for capacitors. And where do you find those? In EVs, in renewable energy, basically the future. This is the high-margin, high-tech, but here's the catch. Look at this mix right now. That stable but kind of low-margin COEX business, it's making up almost 3/4 of all their revenue. And the Biax division, the one with all that insane future potential, it's just a tiny slice of the pie. The whole point, the entire strategy we're talking about today, is designed to completely flip this chart upside down. And that brings us right to the heart of it. This is the big move. To flip that revenue mix, Xpro is making a massive 800 crore rupee bet. This isn't just about growing. It's a gamble to become a top dog globally in that high-tech film market. So how are they doing it? Well, it's a really smart two-pronged attack. Here's the game plan. First, they're pumping up their plant in Barjora, India. The goal here is simple: kick out the imports. Right now, about 70% of the special film in India is imported. They want that market for themselves. And second, and this is a brilliant move, they're building a totally new plant in the UAE. This is their ticket to the global stage. It acts as a de-risked supply hub, gives them great access to the big money US and European markets, and lets them cash in on that whole China plus one thing, where everyone's looking for suppliers outside of China. And just to put this number into perspective, 800 crores, that is a huge bet for a company this size. Let's be real clear. This isn't just some small expansion. They are literally aiming to transform the entire business, tripling their capacity in the high-margin stuff to fundamentally change their earnings power. So you're probably wondering, how in the world can they afford a gamble this big, especially when their profits are taking a hit? Well, that's where this concept of a fortress balance sheet comes into play. It's genius, really. Before they even started this whole thing, they went out and raised almost 300 crores in equity. The money's already in the bank, so they've completely taken financing risk off the table. Now all they have to do is execute. All right, let's zoom out a bit and look at the competition, because you need to see this to understand why this gamble is so important. The whole specialty film industry is basically splitting in two. There are two camps, two paths you can take, and they lead to very, very different places. And this table just lays it out perfectly. You can see the split right here. On one side, you have the innovators. That's Xpro and a company like Garware. They're all about tech, niche products, and they build these fortress balance sheets. They're sitting on cash. Then, on the other side, you have the scale players, like Nahara Poly. They're just trying to compete on volume, selling commodity stuff. And they often get trapped in what the source material calls the commodity quagmire. It's exactly what it sounds like, a swamp of low returns and crushing debt. Xpro is betting the farm to make sure they stay on the innovator side of this divide. Okay, let's talk numbers. Because all this investment, it creates a really classic financial pattern. It's called the J-curve. And the idea is super simple. Things have to get worse, sometimes a lot worse, before they get dramatically better. So first up, the pain. You see it right here. As all that investment money hits the books, before the new factories are actually making anything, you see key numbers like return on equity just plummet. It's projected to hit rock bottom in fiscal year 26. This is that painful but totally deliberate dip of the J-curve. But then, here comes the payoff. This is the good part. This is the upward swing of that J. Once those new high-margin factories start humming and ramping up, look what happens. Profits are forecast to just explode. We're talking nearly tripling in fiscal year 27 and then growing another 50+% the year after. This is it. This is the massive earning power they're trying to unlock. Okay, so let's pull it all together. What's the final verdict here? After digging into Xpro's whole strategy, it's pretty clear. It's a story of a huge, massive opportunity. But, and it's a big but, it's also packed with some serious risks. Let's just lay it all out. On the plus side, the strengths are huge. You've got this game-changing expansion into a high-tech, high-moat business. It's fully funded with that fortress balance sheet, and they have a really clever global plan with the UAE plant. But the risks are just as real. I mean, trying to build two complex factories at the same time, that is incredibly hard. Their operating cash flow has collapsed for now. They're taking on new debt in foreign currencies. And something to watch, their auditors even pointed out a small weakness in their financial reporting. So there's definitely stuff to be concerned about. And really, it all comes down to this one single question. They've de-risked the money part. The financing is locked in. The strategy? It looks brilliant on paper. But the factories aren't built yet. The production lines aren't running. So success or failure now comes down to just one thing: execution. Can management actually pull this off? Can they deliver on this incredibly complex plan? Because the answer to that question, that's what will determine if this massive gamble pays off and becomes one for the history books.